Welcome, everyone. My guest today is Managing Editor James Kleimann to talk about the mortgage M&A landscape and possible federal regulations that might deal even more pain to the housing industry.
We may have just gotten back from Gathering of Eagles, but we're not done with events for 2023 yet. This October, we're headed right back to Austin, Texas for HousingWire Annual, and we want to see you there. We've got a power-packed agenda with content such as our Women of Influence speakers, peak performer playbooks, CEO playbooks, and more to propel your company forward, as well as a bunch of networking events. Because this event is open to real estate executives, mortgage, title, and everyone in between, you really have the opportunity to network with people from all across the housing ecosystem. If you want to learn more about the event, or if you're already ready to get registered, head over to housingwire.com on the events tab and you can learn all about it. Not to mention, if you're an HW Plus member, you're going to get 50% off your ticket. So get registered for HW Plus and get registered for the event so we can see you out in Austin.
James, welcome back to the podcast.
Hey, good to be back, Sarah.
Great to be back with you. I would like to start out with one of the features that we published this week that was so good. It was by Bill Conroy, and tell us what that's about.
Yeah, so the lead image, I hope people will appreciate, maybe some won't, is a frog in a boiling pot of water. And I think it's really appropriate given the story. This is about some of the stresses, some of the pressures, some of the challenges in the independent mortgage bank industry, and really sort of that stage that they find themselves in right now. And so we wanted to take a closer look at the M&A activity, mergers, acquisitions, and really also look at a timeline, talk to the experts, the people who do this kind of work every day, and get a better sense of, okay, one, how bad is it? Two, how many deals are expected to be struck in terms of mergers and acquisitions? And then who survives? And what kind of timeline are we looking like? And then how big is the opportunity for those who do, in fact, survive? And so that was really the thesis of this feature story that we published yesterday. And I want to start by maybe laying the groundwork here. So hopefully everybody still has good memories of what I call the unicorn years of 2020 and 2021. And you may recall there were a couple M&A deals at the time. Stratmore Group, which they're an advisory firm. They do a lot of tracking on M&A activity in the IMB industry. They found that there were 43 M&A deals involving IMBs with an annual origination volume of about $500,000 or more during 2020 and 2021. So last year, just 2022, that figure alone hit about 50 deals. And Stratmore is projecting for 2023, there will be at least 60 M&A deals. So 2022, 2023, we're looking at about 110, if my math is correct, right? And so Bill Conroy, our senior mortgage reporter, he spoke to Garth Graham. He's the senior partner at Stratmore, and he oversees all of the mortgage lender M&A activities. And he says, look, we have a pipeline right now of companies that have signed letters of intent, but they have not yet closed. And it's significant. It's the highest it has been in years. And if the market does stay as it is, there's going to be a lot more shakeout coming. And one of the things I thought was really interesting about the conversation that Bill Conroy had with Garth Graham is that Graham said Stratmore has a lot of clients, and a lot of their peers have a lot of clients, and they're all doing the same thing, which is they are advising them not to announce when there is an asset deal because the publicity doesn't benefit either of those companies. Who does it benefit? Me, right? Reporter, editor, newsman. And then it also benefits the Garth Grahams of the world, the Stratmores, right? Because they get credit for advising and making sure that this deal goes through. But the actual companies that are merging or acquiring one another, they don't really benefit from this. And so there are a lot of deals that are probably happening right now that are just not going to get publicized, and we can track publicly traded companies, but public records are really scant for private firms that go through an M&A deal. So when Garth talks about 110 deals, that could be a fraction of the total number, because there, as you know, are not a lot of publicly traded mortgage companies out there. We've got REITs, of course. We've got some of the big IMBs out there, but for the most part, these are private shops, right? And so these are also not the only. I don't know if I'd call it an M&A deal necessarily, but there are shutdown engagements that Graham said they've noticed an uptick in this year. There were none in 2020, and these are pretty complicated deals. There's a lot of risk in a lot of these deals, and as we've talked about in the past, are like you can't just shut down. You can't just say, okay, you turn your sign on the storefront from open to close, and then you go on with your day, right? Like you have all sorts of loans, you have all kinds of personnel issues, you have debtors, you have it's quite a process to do that. And so most of the time, according to Graham, when a shutdown is being pursued, it's because the lender's executives just waited too long to find a buyer and they just run out of cash. These aren't like, specific moments in time where something goes wrong. This is kind of as the story says, the frog in the pot. So that's one really interesting part of it. And I thought we could also talk a little bit more about some of the reasons why this is happening, and then get into when some of the conditions are measurably likely to improve for the IMBs. And so, just starting there, I guess the best question is, okay, so why is this happening? And it's a lot of stuff that we've talked about in the past. The big one, according to the sources that Bill Conroy spoke to, is the rapid pace of these loan repurchase demands coming from Fannie Mae and Freddie Mac. They made it really difficult for these struggling lenders to remain in compliance with both the GSE, but also the warehouse covenants. And so those covenants require that the lender has, it's typically like a minimum net worth or income. And if it's breached, those agreements can be canceled, right? And so if you're an IMB and you're cut off by the GSEs for violating, say, the net worth covenant, yes, you could sell those loans to loan aggregators. But if there's a covenant violation, the warehouse lenders are probably also going to jump in, and they're going to be pretty suspicious. So Bill spoke to Brett Ludden. He's the managing director at Sterling Point Advisors, similar to what Garth and the folks at Strathmore do. And he told Conroy that warehouse line providers, they're going to look at that and say, okay, hold on, wait a second. If you're getting cut off by Fannie, I'm going to assume that Fannie knows something that I don't. And then it really starts to go south from there. And obviously you can't fund new loans if your warehouse lender cuts you off, right? So it becomes sort of that vicious cycle. And at that point, just a lot of them can't recover, especially when you're on the smaller mid-size kind of, zone. If you're a Loan Depot, a Guaranteed Rate, a UWM, a Rocket, you can absolutely weather some of those issues. But let's say you're a lender that's pretty small and you have to repurchase the loan. So you either sell it at a fat loss in the scratch and dent market, or you hold on to it. And the hope is that you can sell it in the future at just less of a loss. No profit there, like not going to happen. So if you're a big player, it's not fun, but you're going to be able to handle that. But let's say you do about $1 billion in origination volume per year. Even let's say 4 loans, that's going to be about $1 million out of your cash position. And if the covenants require that you have about $2.5 million in net worth, and cash requirements also, have a specific number, you need to stay in compliance with those covenants. And just, you don't have the scale, you don't have enough business coming in, you can't really do that, right? So that's bad. That's really bad. And I think that's really one of the main reasons these analysts believe that we're going to see just a wave of, generally speaking, smaller players that are just not going to be able to make it work, especially if they had any difficulty with underwriting, and they're going to, especially if they have any difficulty with underwriting and they're just not going to be able to weather, say, more than 4 loans, right, that come through.
Right.
So that's kind of where we are on that part.
So, we've been reporting on the repurchases that Fannie and Freddie are requiring now, and how maybe, from the Fannie and Freddie perspective, they're like, oh, we haven't changed anything. From the lender perspective, it's like they're being way pickier than maybe they have been in the past, but especially in this environment, it does have this really a weighted effect that it didn't have before, right? And just from market conditions. So did the story go into how much of that might be a factor here?
Yeah, and one of the theories here is that maybe the reason Fannie and Freddie are pursuing these repurchases with such gusto is they don't think these lenders are going to be around, right? So you want to get it now before it's an insolvent company and there's nothing to recover. And everyone knows that the GSEs need more capitalization if they're going to ever get back to the level that I think pretty much everyone is targeted. So that's part of it. In terms of the timeline, I think that's really where things get difficult. They're not through, the full period in which there was that mortgage boom in which loans would be, I think, more scrutinized and lenders generally didn't have as much capacity to handle. And, not that I think anyone will suggest that there's just a huge amount of bad loans, that are out there and that there's tremendous risk involved, but there are going to be a couple defects here and there. And when you're doing a million loans, a week, a couple of them are going to have a problem with income, or a couple of them are going to have a problem with, some other component on the docs. So yeah, I mean, we're not through with that yet. The question is how long, and are they going to remain as aggressive as they have been? And again, this is not an issue that I think is going to hurt the biggest of the IMBs. But definitely if you're a mid-sized or a smaller company and you don't have a great cash position, and really look around, like how many do, we could look toward the Rockets and the UWMs and the Loan Depots and, the big names that we always talk about. And I think they would have the money to handle anything like that. But unfortunately, because these are generally private companies in the mid and small space, we don't have a lot of insight into how much money they have on hand, about other sources of capital they'd be able to tap if something goes wrong. And so it's one of the exciting parts, and one of the reasons that we rely so much on just talking to people consistently and finding out what's going on, because it's not going to show up in a public document.
Yeah, I think the timeline of this cycle, so we all know we're in a cyclical business, but the timeline of how, first of all, how fast we got into trouble with the rates going up, at that velocity in 2022, I think that surprised many people. Everybody knew it was coming. What no one could anticipate was how steep that was. And then now I think we're still grappling with, like, okay, where's the end? Where does the cycle turn? And I think that, Bill looked at that too. He asked some people about that.
Yeah, and so we've always talked about the suddenness, like how sharp the change had been, and it was historic. We had never seen this. I hope we will never see something like this again in our lifetime. And so that shock is no longer novel. But what is really interesting to me in all this is how long this condition has remained. And I think a lot of people believe that the mortgage market has been down longer than was expected. You remember all the charts and the forecasts, even, mid last year, around this time last year, how many of them were like, oh yeah, we're going to have rates again in like the high fours, maybe low fives. Volumes are never going to be like 2020 and 2021 again, but it's going to normalize. It's going to look like a relatively healthy market. And as we sit here on July 20th, that's not what we're looking at. We're probably eyeing about 1.5 trillion in origination volume this year. And we still have the capacity issues where, I mean, the industry would need to right size by probably 50 to 75% for that to actually level off. And that's not going to happen, right? So I think what's interesting here is we're looking at rates to drop. We're looking at volume to climb. The question is when, right? And nobody really has a crystal ball, but if you're just barely making money now in the second quarter, when a lot of margins did recover for at least the publicly traded companies that we are able to track, maybe that persists in the third quarter. Maybe there's a little bit more volume. Maybe some of them do fairly well, but then we're getting back into the winter period. There are questions as to whether seasonality matters anymore, or if it's just entirely dependent on mortgage rates. But let's assume that seasonality still does make a difference. They're probably not going to be seeing a lot of companies that make money in the fourth quarter. Probably not much in the first quarter of 2024 either, right? So Bill Conroy spoke to Brian Hale. He's been in mortgage forever. He runs Mortgage Advisory Partners. He said he thinks maybe mid 2024, even 2025, is when we'll start to see that kind of renewed boom in housing and mortgage that we've been really desperately hoping for. And so if you're a lender and you survive, you're going to face a much skinnier industry. And as a result, there's going to be a lot more opportunity for you. There's just fewer players who can compete for those loans. And Bill also spoke to Brett Ludden at Sterling Point, and he said the next 12 months is really going to be the test of who survives and who disappears from the market. And if you're breaking even right now, you're not making money in the fourth quarter of 2023, and you're likely not making money in the first quarter next year. So the next time you'll likely make money is going to be March of 2024. And so that's a long way to go. And if you get to August or September of next year, you're not in super shape, I'd say you're in real trouble. So there are differences in some of these timelines. And again, so much of this depends on, the health of the overall economy, the market. But at this point, I think it makes a lot of sense that if you are able to survive, you're going to do pretty well when the boom, maybe it will be a mini boom, maybe a more muted boom than I think many would hope, but so much less competition to face. So the question is if you're at a company that survives or not, right?
Absolutely. I recommend all our listeners go read that. It's a really good, well-reported story. I think that's great. I wanted to, you talked about how the overall economy, what that looks like. And we had another story this week about the Fannie Mae survey of lenders and how they're feeling about their own business and the economy in general. Walk us through that one.
Yeah. So the Fannie Mae economics group, they put out quite a few surveys, and they've been looking to gauge really, okay, how are our lending executives feeling about the economy right now? How are they feeling about their own businesses? And there were a couple really interesting points here. One, I thought, no surprise here, the top priority from a business standpoint for about a third of the executives who responded to the survey is cost cutting. And that should come as no surprise. We already talked a little bit about sort of the difference in capacity versus just the volume of business coming in. And then the second part of it was really streamlining those businesses, right? So 32% ranked business process streamlining as a top priority for their businesses. So they need to reduce costs through minimizing manual tasks, improving accuracy, maybe consolidating some of your vendor relationships, or looking for more affordable options if you do have some expensive vendors out there. And then they were also looking, which I think is encouraging, at consumer-facing technology and talent management and leadership, because these are durable, right? If you have good consumer-facing technology and you're able to maintain a relatively speaking healthy amount of volume, that is something that you'll be able to continue for the foreseeable future. If you have a really poor model and it's bad customer experience and you can't really ever get over the hump, I think, your days are probably numbered. You need a good consumer facing technology focus at this point if you're going to survive this kind of business. And then the talent management and leadership position, I mean, that's always the calculation, right? I mean, your organization is strong as the people that you hire. And that's not just recruiting well, but that's making sure that the people who are there are satisfied and doing good work and have challenges and have a healthy mindset and mentality. So these are all good, solid components here. But let's talk a little bit more about the economy. So when I read Bloomberg, the Wall Street Journal, I think, wow, the economy is doing pretty well. It's maybe surprising how well the economy has done. And so many people had projected a recession at this point, if not sooner. Some still do. No one is, I think, concretely saying that we're out of the woods on that front. But what you see in the jobs report, what you see in the inflation, the CPI report, that doesn't quite match the sentiment from the mortgage lending executives that were surveyed by Fannie by Fannie Mae. And just to take a quick look at that one. So the surveyed lending executives had a really pessimistic outlook toward the economy. So about 73% of the respondents believe that the US economy is on the wrong track. And about 93% of the lenders believe the economy is very likely or somewhat likely to enter a recession in the next 2 years. And among them, 68% of the lenders, the lending executives, I should say, expect the recession to start in Q3 or Q4 of this year. And I thought that was really interesting because I keep hearing about this soft landing, about this idea that maybe the housing market has already reached the bottom, and maybe the Fed is done with its rate hikes, with the exception of maybe one more, right? And that should, even if they don't lower the rates until even summer of 2024, just having that pause, providing stability, especially to the capital markets, the secondary market, that would make a huge difference. One of the biggest complaints that I hear from executives and loan officers as well is just the secondary market is such a difficult place right now, and the spreads are crazy. And how do you price something that changes? The volatility is so crazy right now. They just want normalcy. If rates are 5.75, but it's normal and you can get a healthy spread, you can sell it quickly, that would be amazing. We just don't have that right now. Will we in the future? Yeah, at some point. The question is when and how many of these companies will be able to withstand the pressure before, we get to that stage.
I think that all makes sense when you think about there's the overall economy and how people are experiencing that. And then there's people in housing, mortgage and real estate that, housing has been in a recession. Logan called it since last June. And the Federal Reserve has been fine with that. In fact, the Federal Reserve is like, we need a housing reset because they saw it as one of the sectors that was just out of control with inflation. So they were happy to, put the pain on housing. So it's no surprise that the housing executives can feel like, even if other things are going well, or wage growth, or, whatever, it's like, you are not feeling that in housing yet. And I'm not sure when you will, to your point. The volatility is a big thing. If we can, even if we got into the low sixes and stayed there and got to sort of a new normal, and to your point, people could feel like, they can understand what their cost to list their house is. There are just so many factors, but I agree with you that, it's not surprising at all that people in mortgage and real estate are feeling the pain way more than maybe the general overall economy is feeling.
Yeah, and look, it's always going to be the tip of the spear with housing because it's so heavily tied to mortgage rates and the cost of financing, right? I mean, that's been true of every prior housing market. It probably will for a lot of others. What I think maybe the Fed didn't expect or hasn't fully appreciated is, one, how much of a lag some of the instruments they use to gauge, housing inflation are. I mean, we talk about the rental component; it's like 40% of the CPI, and it's like a year behind, like literally a year behind. It doesn't reflect new leases. I think it's a really poor metric. I know there are a lot of economists out there and observers who think it's silly that the Fed is like using, like an abacus when everybody else is on the TI-90 or whatever the kids have these days for calculators. But when I was a kid, like the TI, was it 89 maybe? I don't remember. But anyway, like that was the gold standard. So that's part of it. But the other is like, what reset? Like, when I look around, if I'm looking to buy a house near, my wife's sister lives in Princeton, New Jersey, and they bought there in 2020, and they got a rate for like 2.7. They got $1 million house, beautiful, like incredible. If you tried to buy a house there now, the prices only went up since then, even since they started hiking the rates. House prices are not coming down. There are a couple select markets where price growth got totally crazy and couldn't ever support itself. If you look at Altos and you look at where you're seeing the biggest, number of cuts, it's those crazy boom markets that got well overheated and could never sustain just based on, the demographics, the profile of people going there, whatever. So you're seeing like 50% price cuts in like Austin, Texas, and a lot of the markets in Florida, but you're not seeing that really anywhere else. Like, these markets are not going to see declines in pricing, at least in terms of pure house prices. There's no reset. it didn't happen. We just now have fewer sales. We have less mobility. We have, some multifamily coming, which will help a little bit with supply. We do have some new homes coming that will also help in supply, but it's a very uneven, it's a very regionalized, um, you know, set of supply. It's really in kind of the deep south mostly, and then in parts of kind of the Southwest and a little bit in the Midwest. But I mean, if the Fed was successful in crippling housing from a volume productivity standpoint, but not in making housing more achievable or affordable for anybody, they screwed the pooch on that one.
Well, we're about at the end of our time, but I wanted to ask you about some other reporting that you're doing, which is unfortunately, along the same thread of like some federal regulations that could put more pain on the housing market. Tell us what listeners and readers should look forward to there.
Yeah, so my autocorrect keeps misspelling it. It should be Basel 3, but being from New Jersey, I think my phone, maybe AI is getting too good and it keeps spelling it as Bagel 3. So maybe it's trying to tell me something. I need to eat more bagels or something. But anyway, so big story from Bloomberg earlier this week. They reported that the Fed, a couple other regulators for the big banks are looking at really changing quite a bit of the risk based weight framework for mortgage as it relates to these large depository lenders. And, it's no secret that the mortgage industry has really turned toward the independent mortgage business model because they don't have so many stringent regulatory issues to overcome. And, especially when you look at affordable housing, who's in the Ginnie space, who's doing FHA loans, who's doing that kind of product. It's not JP Morgan Chase. It's not Wells Fargo. It's not US Bank. That's coming from the IMBs. And, I think were it not for a lot of these regulations that came in the wake of Dodd-Frank, you would see a lot more credit availability coming from the banks, but they're really not there. And I think personally, I think they're probably right. It's not a very level playing field. You have these big independent mortgage banks. That's all they do. They get the loans off their books real quick, whereas the banks hold them. And so if they're going to have to cover even more capital, in holding, it's not going to cause them to do more mortgage lending. They're going to retreat. If your risk weight jumps from 50%, which is basically the standard now, we're not talking about Fannie and Freddie, by the way, we're talking about other mortgage products, so not GSEs. But if you go from 50% to say 70%, 80%, the bank is not going to do that loan. It's just not worth it. They don't make it, in a lot of cases right now, these banks are doing these mortgages because they want to get some other business from that client in some other fashion. Maybe it's attached to the private wealth segment, or maybe, there are commercial loans that they want to work with, or maybe, that they have another purpose. But mortgage lending is not a space that they're particularly excited about, not one that they've particularly resourced in recent years either. And, I think this will have other potential impacts as well, especially on MSR sales. And then, we talked about this a little bit earlier in the podcast, Sarah, but the warehouse lenders. Who do you think is, in the warehouse lending game? It's banks. It's all banks. It's regional banks. It's, in some cases, bigger banks. But that's not going to, I don't think that's going to encourage, more stability and credit availability in mortgage overall, right? Because all the independent mortgage banks, that is their fuel. That is how they do their jobs. That's how they make the loans. So yeah, I mean, we're going to see. We'll have a story coming out later today, and we've been talking to the experts. The MBA is not happy about it. A whole series of others are unhappy, especially the banks. They're pretty unhappy about it, especially the regional banks. Anybody who's doing jumbo is not going to be thrilled about this. So yeah, it's going to have widespread implications if it does come to pass. We don't know that it will. Like I said, this is just reporting, and we'll have a lot more visibility this time next week, Sarah. Thursday, July 27th is supposedly when this series of regulations will drop.
We hope that there is a whole series of frantic lobbying that's going on from different sectors to put a halt to that particular part because it's like, I don't know, do you just want to kill the whole segment off? I mean, you know, taking this on right now, doing this right now seems just wholly irresponsible from my perspective. So
Yeah,
we'll see. We
we'll
will.
see.
Thanks for having your newsroom be so focused on the things that our audience cares about so much. And James, thanks for being on.
Thanks for having me.